There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them.
Welcome back, traders and investors. We have Reverend Emmanuel Lemelson on the line. He's the founder and president of Lantern Foundation and the chief investment officer of LemelsonCapital Management. He also happens to be rated by Barclays Hedge Reports, just one of the top hedge fund managers in the world. How you doing today, Reverend?
I'm good, thank you, Joel. How are you?
Doing good here. We'll get to the overall markets here in a minute, but just want to talk about some of your current positions in the market and how you're letting the recent sell-off affect your positions. I guess first start with your short position in Ligand Pharmaceuticals. I know the company has come out with some statements trying to be a little bit positive, but I know you were talking to Brent the other day, and it didn't seem like you were really buying what they had to sell.
Yeah, that's basically true. I mean, we're still short Ligand, and I think the pre-announcement has become part of a pattern of reporting non-GAAP earnings. There's a place for non-GAAP earnings, but I don't think that place is Ligand. If you read this company's annual reports and if you dig into why they're using these measures, in this most recent earnings announcement, this pre-earnings announcement, it's really, again, to sort of cloak the stock option awards to management. And secondly, it's to cloak this extremely expensive bond offering. It was about 18.5%, the cost of their debt. And so I think anyone interested prospectively in investing in Ligand should probably take a close look at what real EPS would be, GAAP EPS, because those would be the earnings going to the owners, the shareholders. And that's extremely finite. I mean, it's immaterial, actually. So the suggestion that you're going to use non-GAAP EPS, shareholders are never going to see that money. And I think that's important to understand if you're a Ligand shareholder.
Do you think that this is something that's specific to this company, or do you think that there other companies that you're doing research on follow this pattern of reporting as well, and disbursements of earnings?
No, it's not unique. I mean, Berkshire Hathaway, for example, uses non-GAAP earnings all the time. So there's very good reason. The way they look at the value of their company and how it generates cash flow and increase in book value, they're identifying accounting pronouncements in GAAP that are not really relevant to the way that company's functioning. They're not trying to cover over anything like stock option awards or the real cost of their debt. So there's a spectrum of companies out there in the way they report, and not all management teams are equal. So you have to look at each company and each management team uniquely and ask yourself, what's the quality of this leadership team? And why would they be using non-GAAP measures versus GAAP?
Okay.
I hope that.
Yeah, no, that explains it. All right, so let's move on to some of your current positions here, and you've been riding the Apple wave here, and the stock has made new all-time highs, and I'm sure you liked Carl Icahn's prediction that it's going to 200. Interestingly, the street thought a little bit different. I actually noticed when he was on CNBC last week that the stock actually sold off during it. But, you hung around that all-time high for a long time. The $100 level really equates nicely with the former all-time high at 705.
Sure.
And then, it's just finally, it was holding up there. It was ignoring the market. Then the last couple, yesterday, really, the bottom fell out. Are you getting a little nervous here? Are you trying to sell some calls, buying some downside puts, or are you adding to your position there?
Not at all, Joel. I wish we could add to our position. I mean, I'm basically looking under the couch pillows for spare change to buy more stock, to tell you the truth. Carl Icahn's a very smart man, and I had no idea, of course. Nobody knew you'd write this letter and publish it. Maybe it's slightly aggressive on his price target, but talking about Apple at $100 a share is not the same as it was 2 years ago because there's fewer shares outstanding, revenues have increased, And it appears profits are certainly going to increase in the near future. And I don't know of a company that could offer more than what Apple's offered its shareholders and its owners recently. I mean, and tremendous demand for their products, and they're growing every business just about, except for the ones that I think they're not interested in growing. The iPod business obviously has gone away; it's immaterial. But that P&E looks very, very cheap, and Apple is going to be very safe. I think this sell-off is very temporary. Even if Carl Icahn was wrong, and he's a very smart man and has a lot of experience, but if he was wrong, let's say Apple is only worth 150 a share, not 200. You're talking about 50% upside, and that's probably going to materialize in the next year or two, I would imagine.
Wow. So you don't have any.
It's hard to say something with Carl Icahn and say, how far apart could he be? I mean, just talk about him. I don't think he put his reputation on the line, but that has nothing to do with our opinion of Apple. Our opinion of Apple is formed with our own research and ideas, and it's a position kind of holding for a long time.
So you don't have any sell orders out there at all, and you really seem to be no, and unshaken by the. Okay, all right, good, extreme confidence. Okay, another one of your holdings, and I love the way you played this one from both the long side and the short side. WWE here. Had a nice, I believe it got up near the $15. Oh, excuse me, got up near 16. I believe last time you were on the show, kind of pulled back with the market, holding the $14 level here. It looks like it's trying to build a nice base here to rally back up. Any thoughts on WWE?
Well, we're so long the stock. Again, it's a great business, a virtual monopoly. They are undergoing, a bit of a turnaround there. And I think that'll take a little time, but I do think they'll reemerge, and I think that franchise will be around for a very long time. So the fact is that we don't like to sell things. WWE is a lot more fairly priced now than it was before. It's not the same deal it was at $10 or $11 a share, but if you look into the future, down the road 4 or 5 years, even these price movements of $2 or $3 a share in the case of WWE, they may seem large today, but they're not going to seem large down the road. And the same is true of Apple, actually. The longer term your horizon is, the more you're projecting into the future, the less these short-term price movements really have any effect at all. I mean, again, they may seem large today, but enough years down the road, they're going to be completely immaterial.
Okay, and the other one that I'm looking at here, Kulik and Safa there. That stock's had a little bit of problems here. Dipped back down to the $12 level, but now seem to be recovering. You still sticking with your thesis on that one?
Oh, absolutely. I mean, if you have to mortgage your grandmother's house to buy those shares, do it.
Right.
Yeah. I think their enterprise value a couple of days ago was $300 million, something like $700 million in cash. They can buy back over 50% of their shares at that price, and approximately. There's nothing wrong with that business at all. But that shows really the power of fear in the markets. And, CEO of another chip manufacturing concern made a comment about a slowdown in semiconductors, very volatile. But one shouldn't confuse price volatility with the intrinsic value of the company and its underlying business, which is very sound in the case of Kulik and Safa. So there's really almost no risk there. And you probably noticed as the market sold off yesterday, Kulik and Safa was actually up, and it's not really surprising. It's really undervalued at that price. Any company that has, almost 70% of its share price in cash and is aggressively buying back its own shares, you're going to be very safe. And, of course, the key to wise investment policy, Joel, is it's just always thinking about protecting your principal. It's not wondering what prices are going to be tomorrow. It's really entirely defensive all the time. So it's very, very defensive stock, I think, you're looking so far.
Okay. This one I don't think we talked about before. And American Eagle Outfitters stock has had a nice run. Give us your thoughts on that. How long have you been active in it? These teen retailers are just so up and down. Do you think this has maybe some takeout value in it, or what's your thesis on American Eagle Outfitters?
Well, actually, I think it was our first interview together, Joel. I think you had asked for some advice on different sectors, and I think I might have mentioned specialty retail at the time. American Eagle really came down with the whole sector, and there are some retailers that are in real trouble. like Postal ARO. Those are special situations. It's very risky, hard to know what's going to happen. And the underlying thesis there is that mall traffic is declining because online purchase is growing. And that's true. I mean, that's a secular change. But it's not one which is going to happen overnight. And it doesn't mean companies like American Eagle won't be able to participate more in internet sales. But that company, I think, was getting lumped in with companies that really had serious problems, like ARO. And if you look at what AEO was, it was still companies much better capitalized. They were paying a very high dividend. So we bought aggressively last fall. And our average purchase price was in the 11s. And the stock did very well. I mean, we bought it really through, I think, either May or June of 2014 when it hit lows. And then, you didn't have to have a crystal ball to realize that people were going to go back to school and go shopping and so forth. And, the price appreciated tremendously. I think in August it was up 39%. So we still have a long position in that company, not a very large one. I mean, it's really much closer to fairly priced now. Specialty retail is not for all investors. It's very risky. It's very volatile.
So
I think competition is fierce, but that was a situation where the value was clearly greater than the price when we were buying it.
So are you been pairing your position, or you're still maintaining it?
We have a small position in the company still, but
okay.
we took a significant profit on it.
That's really, never go broke taking a profit. Okay, all right. let's just talk about the overall market here. Holy smokes, we've come almost 200 points off the all-time high. A lot of fear in the market. Whether it's justified or not, we'll have to see. Are you shaken by this at all, this pullback that we have? I mean, I guess you can look at it in one perspective that, hey, here's a great opportunity. We pulled back 200 points off all-time highs. If you're looking at it, things from the other perspective is, we're still way off the lows of the moves and stuff and could still see some considerable downside before we turn around. How are you approaching this recent sell-off in the market?
Sure. Well, it's not totally unexpected. I mean, in our Q1 letter that we sent to our investors, we talked about the levels of margin debt in the market, and I think we may have talked about it as well in one of your private shows, but interest rates have been very low, and people borrow money in the markets to buy stocks, and this can drive prices higher. There's also, this increase in the money supply, which leads to inflation, and that, common stocks are assets that inflate in value. So the markets are expensive, and they've gone up pretty steadily for 5 years. I mean, it's just been a stubborn march higher. So this pullback, it's really a good thing. I mean, it's healthy, actually. People have to remember markets can go down. In the case of the Embona fund, it really worked out extremely well. I mean, it's just unbelievable. But we did extremely well in our longs, believe it or not. First, we had some huge profits on our short side. And we went into this crash with a very greatly enlarged short book. All of those did well across the board. We took a huge amount of profits, reinvested them in some issues that, frankly, we couldn't believe the price. I mean, there were some companies you could buy almost as tangible assets, and you were getting productive companies that were profitable for their entire life, basically, for free. That happened in a very short period of time. So this volatility really served us very well. And yesterday, for example, even when the market was down 406 million, we were up dramatically on our longs, mind you. So, it's worked out well for us. We were down a little bit in September, the fund overall, and but it looks like we're going to have a great fourth quarter. So.
Okay, so standing in the face of fear, Reverend Emmanuel Lemelson is looking at this market, looking for bargains based on his models and sticking to them, been doing well for you, as we could tell by your returns, being one of the top hedge fund manager. Just final words of advice for investors in this volatile market and, different things going on besides, the actual earnings and the numbers with the Ebola. What final advice do you have for our listeners?
Well, Joel, first, it's important not to be overcome by fear. Fear is really the enemy. And try to think long term. The longer you can live in the future, the less likely you are to be affected by these forces in the interim, which will lead you to emotional states of mind, fear or greed. If you have CNBC, turn it off. It won't help. And then in terms of Ebola, I mean, first and foremost, it's not an economic event, it's a human event. And we have to pray for all those people who are sick, suffering, and afflicted, which are many thousands of people. I mean, I read an article today that said they were anticipating 10,000 new cases a week. These people are the work of God's hands, and we all have to pray for them because the Lord hears the prayers of everybody. And we have to pray also for their caregivers who put their own safety on the line to try to save these people. But I don't think the outbreak will spread in the U.S. as it has in West Africa, because the U.S. is very organized and has a very robust medical system, probably one of the best in the world. So we should keep it in perspective. And maybe it's also a reminder to us, particularly in the financial world, that life is short, and to really value life a great deal, and not to get too caught up in the day-to-day things. That might seem very important in the near term, but in the greater scheme of things, aren't really that important. I mean, our work and so forth in financial markets. So Ebola, if anything, should be a reminder of that. I hope that answers the question.
It surely does, and it answers it very well, putting things in a proper perspective. Reverend Emmanuel Lemelson, founder and president of Lantern Foundation and chief investment officer of LemelsonCapital Management. Where else can you hear the top-rated hedge fund manager in the world? Thanks for coming on. Thanks for being a big supporter of Benzinga. Love having you on the show, Reverend. We'll talk to you again soon.
Nice being with you, Joel. Again, thank you for the invitation. It's always a pleasure being on your show. Take care.